Okay, so very good morning. Welcome to the briefing then for Thursday the 15th of September, a very memorable day for the financial markets, for those who can remember. I'm sure Will, sitting not far from me, certainly can. I know at this point, on this day 8 years ago, I don't think I'd slept for about 2 days straight because the financial markets were in turmoil. Much more aggressive movement, I would say, back then than what you've seen anything like at 2016, because you had the filing of Chapter 11 bankruptcy of the oldest financial institution in the US, Lehman Brothers. Though the impossible happened, and the government let that bank, I guess, to teach a lesson to the market, the whole moral hazard issue, they let it fail, and after that caused a monumental disruption to the financial markets and bank runs to the degree I remember. I used to have at the time, all the individual equity stocks in the S&P. I could see all the bank stocks, and they were getting hit, I would say, anything from up to 20% on a daily basis would be not unusual. You know, if you talk about Italian banks moving at 10%, that kind of captures a lot of attention these days. But, you know, these banks were moving double digits every day. Just quickly having a look, to put in a bit of context as well, of monetary policy and the way the markets have gone since then. This is September of 2008. This was when we kind of came off the peak in 2007. So this is kind of the main part of the financial crisis. The low point of which, if you know, the S&P was trading, if you can believe it, I guess for the new guys, this is more of a novelty, but we were trading down at 665. Don't forget, we were testing 2200 to the upside just a few weeks ago. You know, the pace of this move that we've seen in equity markets is absolutely phenomenal. And this is the unprecedented era of the new central banking that we're in, with quantitative easing first and foremost. Obviously the US being the most proactive in getting that underway. The ECB probably being the slowest, and you could argue then that that's to their detriment. Because if anything, in the monetary cycle now, the Fed are looking to increase rates. You know, they finished their, let's say, QE program a long time ago. They're on the precipice now of returning to a hiking cycle of normality, whereas the ECB are at the tipping point of just about to expand their QE program even further. The Bank of England are committed to doing more easing. So if anything, you could argue that by going in heavy-handed at the beginning, which I know many people questioned Bernanke at the time, the US Treasury for stepping in and doing what they did, but ultimately by doing that, they did manage to actually get ahead of the curve, and ultimately a few years later now, that has paid dividends. The only thing is, in the future, now that, as you know, we're running dry almost of the toolkit, if we did have another downturn, that's when certainly things do start to get worrying. But yeah, just putting in a bit of context, the S&P, when you start looking at it at these kind of 10-year horizons, it's a phenomenal rally that we've had really since the worst of the financial crisis. And, you know, love him or hate him, I have to say, Gordon Brown, when he stepped in and they bought out RBS and Lloyd's, I remember at the time there was rumours, there wasn't rumours, there were pictures of queues of hundreds of people queued up at cash points, pulling out maximum clips of money out of the cash point, pulling money out of banks. It was an incredible time, actually, at that point. And he actually, by backstopping those banks, triggered then the bailout process, which ultimately, although some would argue the bankers caused it and us as taxpayers are paying for it, let's say, but ultimately it stopped the actual financial crisis becoming not just a recession, but a depression, if you like, in terms of what could have happened. Anyhow, 8 years ago today, Lehman Brothers filed for bankruptcy, so a quite memorable day for those who were in the market at the time. Moving on though, a quick look at really today's briefing is going to be more about the day ahead than what we've seen thus far. This morning, just quickly swapping my charts, you can see here the dollar index. This is really the morning here. You can see soon as we've come in, UK and Europe, the dollar's caught a bit of a bid tone, so hence the reason the major pairs, euros on the back foot. And obviously this comes ahead of a lot of important data coming out. Not just stateside, we're going to get our teeth into some Bank of England expectations to start with. When it comes to the Bank of England, let's just paint the picture of the economic environment at this present point. Starting off with, quite rightly with this chart, what Brexit? The Remain campaign, that fear-mongering tactic, at least now for the short term, appears to be misplaced. Because looking at these surveys of business activity, they rebounded sharply in August. You understandably had the July fall. That was the first data set post-Brexit. And then we've had this surprisingly strong bounce in across all the major data points here on a PMI basis. Services, obviously, the key component of the UK economy, and also manufacturing, solid bounces, as painful as that is for me to say. Brexit actually not as bad as feared thus far. I would have to stress the point though, listening to the likes of Deutsche Bank's UK chief economist, I saw him on Bloomberg TV talking this morning, other economists of the same opinion. If you remember the financial crisis, even in Q4, so Lehman Brothers went bankrupt in September. Even in Q4 thereafter, in October, November, December of that year, the UK economy was still growing. And actually, data was not impacted immediately, even though the stock market was in turmoil at the time. It was not until about a 6-month lag that then economic data started to soften in the UK, and that ultimately led to sharp decreases in the UK interest rate and ultimately QE and so on and so forth. What I'm saying then is that although things are all fine and dandy at the moment, that's not to say that the worst might yet be to come, and hence the reason the Bank of England have committed in the long term to doing more. Hence the reason they've restarted QE, purchasing corporate bonds, and they've said the lower bound for interest rates is just above zero. So rates certainly have further to go on the downside in that respect. A quick look, more banks though, investment banks, including the Bank of England, have got a little bit more optimistic in terms of revising up their growth forecasts more recently. Bank of England, Bank of America, Goldman Sachs, ABN, they've all been caught by surprise, the strength of the initial aftermath. If you're looking at federal funds rate futures, we talk about a lot, short end of the US fixed income curve, about price movement to garner how the market is positioned on the probabilities of a rate hike. Well, looking at swaps in the UK market, you can indicate then what traders are betting on in terms of percentage. Here on the left axis, you can see that almost 95%, I would say, of the market in sterling overnight index average swaps is pricing no change from the Bank of England. I would say you can pretty much bet your bottom dollar they will not change interest rates today. It's more than obviously just an interest rate announcement, which we'll get onto shortly. One reason why people are so strong of that opinion that they won't move today is really, this is a table that I often see floated around. So this is the economic health changes since the last Bank of England meeting. So this is quite a nice just summary table, because this is ultimately what the Bank of England MPC members would have been discussing over the last 2 days to formulate their ideas of what they're going to announce later on today at midday. So when you look at the data points here, you can pretty much see how that data set is either improving, i.e. sterling bullish, or the opposite. The situation has deteriorated for that particular economic data set. And as you can see here, predominantly green, i.e. activity, all of the PMIs, manufacturing through service construction have all been improvements. Likewise for the actual asset values, consumer side, retail sales has been improving. So in that respect, that's the reason why most people expect them to not change rates today. Looking at the shadow MPC, for any of the new guys, this is something which CCAM do themselves on the morning of an interest rate decision by the Bank of England. Now the shadow MPC is a replicant of the 9-man and woman board at the Bank of England that set policy, the Monetary Policy Committee, the MPC. The shadow MPC is normally a collection of chief economists at banks, former senior Treasury politicians, former Bank of England officials. So they are very much people of influence, people who have previously been in high-powered positions. So certainly people with enough knowledge to make informed decisions. So the market, not so much nowadays I'd say, but previously the market would pay a lot of attention to how the shadow MPC would vote as a hint towards what the actual Bank of England might do. And the shadow MPC, just so you're aware, overnight, they voted 8-1 in favour of holding rates. So this now leads on to the next part of how to digest today's Bank of England announcement, is the vote. So at the moment, we're not expecting any changes to the asset purchase facility, the APF or QE program. We're not expecting any changes to interest rates, certainly no interest rate cut at this point. But what also will be released is the vote split. And that is important because if it's 9-0, as is probably the broader consensus today, i.e. they're unanimous in their view that no policy changes should be taken at this point, then that's seen as, I would say, if it's what's expected consensus, we should see hypothetically no move in sterling. However, as the shadow MPC are indicating, and as I was talking about, Barclays are also looking for the same, there could potentially be an 8-1 split, i.e. one member might have favoured cutting rates now. And Barclays were suggesting that was the newest addition to the Monetary Policy Committee, that being Flager. If that occurs then, and there is an 8-1 vote, then essentially what that means is that would be seen as a slightly more dovish hold, if that makes sense. Because one person has broke away from the pack and they're looking for an immediate cut to interest rates. That could cause some downside pressure in sterling if that occurred. If, let's say, in a scenario, the vote was 5-4 to hold interest rates. So 4 people wanted an interest rate cut, but they were outvoted by one person. So the decision was to hold rates, but it was very, very close. That would be an extremely dovish event as far as today is concerned. It's unlikely that that will happen, but if that did happen, sterling would come under immediate pressure in terms of currencies and how the market would move. So that would be an extremely dovish hold. The other thing to look out for, of course, is the minutes. This will be the conversations that they've had. Usually how these types of events work is the market looks at, as we're not expecting any change on the two main things, the QE and the rate, the market will react first and foremost to the vote. You'll see an immediate whipsaw price action, and then they'll digest the comments to see what the tone is. When are we going to get the next rate cut from the Bank of England? Because it is going to come. It's only a matter of time. When is that time? So that's going to be a key thing to look out for today. Just going back quickly to the schedule for today. Ahead of the Bank of England, of course, that's at 12 o'clock. We have an extremely busy calendar today. Now, one first word of warning when there is a busy calendar is, yes, that will provide opportunity, but volatility also comes, it can be difficult in terms of trading the financial markets. So You've got to have a firm action plan ahead of time. One of the guys here, first thing he asked me was, what should I be doing on a day like today? And I was saying to him, you want to be thinking right now, early in the morning, how the day might pan out. This US data this afternoon is going to be really important because it's going to formulate the idea of how credible is it the Fed will move in September. Therefore, I'm already pre-planning then, where might the S&P go by the end of the day? Where might it go in, let's say all the data is super strong in the US, therefore interest rate expectations for September increase. That imparts downside pressure in the S&P. Where is my next line of technical support? Where could it go hypothetically if the data was supremely strong? And then vice versa. So I'm already building these scenarios in advance so that when it happens, it's more about execution than it is about making a plan there and then and executing, because that ultimately takes time. Going back to specifically the data at hand then, we've got UK retail sales coming up. That'll be first up, 9:30. A quick look at UK retail sales though. And remember, with retail sales, you have the including auto fuel and the ex-auto fuel. The reason why they do this generally with statistics is to eradicate the volatility out of certain components that comprise of the report. And energy, as you've seen, tends to move around in quite large ranges, and that can have an effect on things like inflation, but also retail sales as well, because the price of petrol fluctuates all the time. So the X number will be important. Here is including auto fuel. You can see as a data point it tends to fluctuate quite largely. So do not be surprised if you see type of swings here in the data, but ultimately this data point after Brexit, this was the first reading we had, July, was actually quite strong. And I remember the time that came out, it was up 1.4%, and the market was expecting a 0.2% reading, and we got 1.4%. This was part of the cluster of data which really caught the market by surprise. And if we look at really cable at the moment, this was when we were really making an assault up to that 135 handle that has run out of a bit of steam really since September's got underway. But certainly watching these types of data points will be key to see with the Bank of England going forward. Bank of England, of course, that comes then later, midday. And then we get into the real interesting part of the session, I feel, is going to be more this US data set. You've got Philly Fed, 130, alongside Empire State Manufacturing, alongside retail sales, alongside the weekly jobless data, business inventories, all coming. That's just 130, and industrial production. So you've got business inventories and manufacturing production at 2:15 and 3 o'clock, but 1:30 is going to be showtime as far as economic data is concerned. And I know for one, I can already hear excited Will DeLucy rubbing his hands on the impending volatility to come. So quick look at some of these data points though. As I said, the Fed are in their blackout period at the moment, so they cannot communicate anything more to us. But if you remember rightly, in their last statement, they did say that they would remain somewhat data dependent. Their decisions would be based upon the data, and the data has been deteriorating. The ISM, manufacturing, non-manufacturing and payrolls, as we know, has been getting, if anything, gradually worse. And that's what's made the likes of the volatility, the VIX index, spike up, because that's increased the uncertainty over what might happen in September. So how these data points come out is going to be interesting. And when we get to around 3:30 this afternoon, we should have a much better idea of whether, if all these other data points follow suit and continue to deteriorate, then September's chances get reduced. And the market will likely then, following that theory, should be supportive of equities, should see the dollar reverse, i.e. supporting euro dollar and cable, and treasury should be supported. That's as the probability continues to fall more towards 10% or below of the probability of a rate hike in September. Quick look then, Philly Fed, you've got the regional kind of manufacturing readings. So Philly Fed was slightly positive last time. It has been a fairly choppy summer, but positive nonetheless. Empire is the New York reading for manufacturing index, and that has been a little bit more weaker than Philly. Don't forget as well, when you're looking at these data points, they do contain constituents. So as well as the headline reading that you're looking for, which last time came out for the US, this number was much worse than expected at the time. I remember it was expected at 2.5 positive, so up here, and it came down there as a negative surprise. But you also get the things like new orders, employment, shipments as well. So do keep an eye on those components. A summary of the report. The other big one then, US retail sales showed zero growth last time in the month of July. Expectations were for a 0.4% reading. So again, last time retail sales was a little bit lackluster in the US. If the Fed is serious about an interest rate hike, again, all of these need to show, I think, solid readings to support that argument. Then you've got industrial production. That's been a little bit more healthy, I'd say, 0.4 to 0.7. Last time out was above expectations. And then in terms of initial jobless claims, I would say this is probably lower on the radar of the Fed. I mean, looking at this, I think if I go back slightly longer dated, this is a 10-year, puts it in a bit more context. And obviously, in the height of the financial crisis, a massive spike in the amount of people claiming benefits. However, since that time, if you look at where we are at the moment, we are at an exceptionally low level by historical standards. So even if we get divergence away from consensus readings today and we get a bit of a spike, ultimately I don't think that's really going to influence the Fed too much. So a lot to come this afternoon. I guess it's just a case of being a little bit more disciplined, waiting for the data. What you probably don't want to do is just be trying to trade every single piece of economic data. The UK retail sales come out, you're trading that. The Bank of England comes out, you're trading that. Each data comes out 1:30, 2:15, 3 o'clock, trade. You know, to get to that kind of level of being able to be effectively trading the news like that, let's not forget Will has been trading for 15 years. That's 15 years worth of 10 hours, 12 hours a day in front of a screen, clocking up the air miles. You know, the guy has intuitive reading of the market that's going to take time for you guys to build up. What I think is maybe a more logical play here is to take the data in its entirety and think about what is it telling you about what the Fed are going to do, because ultimately that's going to be the driving factor of the overall trend on how today's markets will finish. You know, the S&P today has the potential to finish. Let's have a look on a chart here of the recent ranges. You know, looking at the ebbs and flows from Rosengren, Brainard, the reversal of that. You know, certainly that 2100 level, which acted as psychological support, as well as the round figure, when Rosengren's sell-off at the end of last Friday, that's obviously a big level there. And if the data comes out strong, then certainly I don't think that can be, that's a strong possibility we'll have another retest at that level. Once we break that, if we break that, then obviously downside pressure might pick up a bit of momentum. Likewise, upside, that's a phenomenal move we had at the end of last week. I certainly don't think, even if they're terrible data and September's wiped off the table, to rally that much, well, it's not impossible, but more so I'd say the top of the range here at 56, even that's a pretty punchy move. We'll see. One final question then, just to finish things off. Answers in the chat, please. As we said then at the beginning of this briefing, Lehman Brothers 8 years ago today filed for Chapter 11 bankruptcy. How many central banks around the world have cut interest rates how many times since that day 8 years ago? If you've done your research and you're reading this morning, you should be able to tell me that answer. Oh, Tim. What is going on? Okay, good. Good to see that you've got the... you've been reading the research this morning. 672 times interest rates have been cut since Lehman collapsed. Incredible. Okay, guys. Good luck with today's session. Guys who are trading live, you've obviously got VAS to oversee you guys in months 2. I know you're kind of forward thinking to month 3, but take today objectively, focus on what's the task at hand, and good luck. Catch you in the chat.